Just a quick introduction, guys, of Gurmeet. He's the managing partner at Complete Circle Consultants. Gurmeet has been in the industry for almost over 20 years and has worked with industry leaders like HDFC Bank, Citibank, and others. And personally, I want to congratulate you, Gurmeet, for getting your PMS license and launching your first strategy as well, Digital Compounder. So congratulations there, and also on your new swanky office in Andheri, I guess. So looking forward to sometime catching up as well in person now that COVID is no longer a problem.
Thank you. Thank you for having me as a guest.
All right, Gurmeet. So, cutting to the chase, everyone is talking about the most important thing right now that they want to know about is, are we in a bear market? Because everyone has their own theory. Some people believe that this is just a correction in a bull market, while others are quite sure about the fact that we are in a bear market. Now, technically, by definition, we're still not down 20% from the highs. But what is your interpretation of things, and how are you looking at markets right now?
Yeah, yes, thanks. I think three words, if you tell yourself very clearly and very loudly, can make things very easy for all of us. Is I don't know, and believe you me, nobody really knows in the short run. I've been in markets for almost 17, 18 years now. In terms of actively tracking them, started investing also a little later. I don't think so anybody knows, right? In terms of, I don't know any brokerage which at 18,000 came and said that we will see 15,000 this year. That time the targets were 21,000, 20,000. There was a competition. And now there is a reverse competition, right? People are giving targets of 15, 14. There are technical chartists who have their own views. I think one clear thing which I have learned over a period of time is controlling the controllables, right? And if you see Nifty last 20 years, since I've been tracking markets, every year almost 18 out of 20 years we have seen a 10-15% correction. There's not almost like 85-90% of the time the market corrects. Once in 2 years you see 20% corrections, right? Best of the stocks you track, Divis, Infosys, best of the multi-baggers, in a 15-year period you would have seen 6-7 large drawdowns. And by large drawdowns I mean more than 20%, which is what qualifies as a bear market. So I think nobody really knows, and because there are so many moving parts around this, we don't know when the war is going to end. We don't know when the supply issues will get resolved. We don't know how commodity cycle will behave. Others also don't know. I speak to so many of them. I think what we can control here is that, what are the good businesses where the business performance has been relatively resilient, and I'm using the word relatively deliberately here. So I don't see an issue with some of the private sector banks. I don't think so they have any exposure to Russia. I don't think so they will credit will slow down beyond a point. They may not grow at 20%, but I think they can still grow more than 15%. I don't see a lot of IT companies facing any demand momentum challenges for next 2-3 years. I know so many companies which have done innovation capex, and by innovation capex I mean, this is largely B2B in nature. Either in contract manufacturing or in specialty chemicals or PLI led, capacity creation in electronics and semiconductors. So I don't see any challenge there over the next 3-5 years, and I get these businesses 20-30% cheaper. I will, if I have liquidity, I will start accumulating, and I would monitor business performance over price performance. And I think that's what has given me a lot of returns in last 20 years, 15, 18 years I've been in market. And I keep saying this, I have not got one single stock where I have made 50x or 100x, and I'm being very honest about it. But at a portfolio level, I have done very well, despite all these drawdowns. So I think if you right now have liquidity, focus on individual businesses. If you don't have one, just stay quiet, and I think this too shall pass. Give importance to what price you pay. I'm not in that camp of paying any price for any business. I've been a little vocal about it. I am a more old school. I don't like the new age businesses which are loss making. I would rarely touch them even if they fall a lot, because I'm a textbook old school investor. I need to see the cash flows.
Interesting. So in that case, Gurmeet, the biggest headline of this week was the Adani Holcim Group deal. What is your take on the acquisition, and do you think this will lead to the entire sector's re-rating?
Yes, I think see any sector where consolidation happens and entities are promoter led tends to have a positive impact on the sector. Interestingly started my career as a management trainee in ACC. So ACC is something which is very close to my heart. So what this does is that it obviously is one of the largest buyout by anyone. $10.5 billion is, I think the last one was Flipkart being bought by Walmart, if I'm not wrong, but that was in service sector. So in infrastructure and material, this is the largest one. So if you go by the what Ultratech has been doing, this will actually create the second largest entity. And both ACC, if you see so obviously there are synergies. ACC, if you see the EBITDA per ton is more like, if you see last quarter, it's about 800, 850. ACC is one of the lesser efficient cement maker. Ambuja is more like about 950,000 bucks, and if you see Ultratech, that's about 1,200. So what this will do is that, assuming there is price discipline, it will improve the both the efficiency and synergy. Also, Holcim used to have 1% royalty payment, so that goes away once Adani takes over. Also, Adani has logistics. Adani has access to coal. Adani has access to the renewable energy space. So it makes the integration very vital, and I think it will be more long drawn. So what I have seen in market is that once the news is there and everybody sees, the prices do not respond. Most of it is in the price. We've seen that with HDFC merger news, and we've seen that with so many other things. So don't react basis just the news, because the news has come in, especially when the news is in public domain. But overall, building material space, I have been very constructive. I call this as a home improvement theme. So you will see more consolidation. Also, if you see the home affordability ratio to income, it's fallen to an all-time low. So despite interest rates going up, I don't see the housing cycle really changing. And not many of you who are, let's say, new to the markets, if you remember, there was a 2003 to 9 cycle. So there was a housing recovery, and it was followed by a broader capex cycle. I am saying it's a little early to say, but I'm seeing similar trends now. I mean, you would have seen the DLF and other real estate companies reporting good numbers last quarter. DLF, for example, has had the best year in a long time after 10 years, right? And along with deleveraging of balance sheet. So I think if I'm seeing an early sign of housing sales picking up, and that should translate into, in my view, some bit of a capex cycle, which I think is very positive for the entire building material sector.
Gurmeet's talking about news. Jet Airways is back in the news, and there was a time when that stock was at some 10, 15 levels, and now it's come to 110 level. Two thoughts here. What's your what are you making of Jet Airways as a script, and generally travel as a sector? What are your thoughts there?
Yeah. One word is avoid. I've rarely seen anybody make money in aviation, but yeah, including Warren Buffett. It's a gruesome sector. So I tell you why. It's not that I have anything personal to do with these companies, in the sense that you can't control ATF prices, which is a significant part of your cost. So actually, 65-70% of the cost is something which is beyond you. Then you got impacted by COVID. Right now I'm hoping there is no other wave, but that's variable of we saw China getting locked down. We saw a third wave. We don't know whether there'll be a fourth or fifth wave. This is beyond me. I mean, even scientists don't know. There are better reopening plays. If you want to really play a reopening play, there are QSR, there are broader home improvement themes. There are other better asset light models which one should look at. Aviation, to me, I think is unless you have access to some news, which I don't have.
No.
I don't think so. It's a great choice. Yeah.
The only thing that I remember when you're talking about aviation being a tough sector, I think it was Richard Branson who said the easiest way to be a millionaire is start as a billionaire and start an airline. So I think that pretty much is in line with what you're saying right now.
Absolutely.
Yes.
Gurmeet, let's talk about the LIC IPO. So a lot of retail investors applied for it, and obviously they did get the allotment, but are now feeling nervous. What should be their strategy going forward?
So I think listing gain. I think any large.
Gurmeet, there seems to be some issue with your audio.
Yeah.
I think we're not able to hear anything.
Is it better now?
Yeah.
I'm saying any large IPO, if you go by, starting with Reliance Power, Coal India, Zomato, Paytm, and by large I mean upwards of 10,000 crores, which is $1.5 billion. I think in our market tends to soak up a lot of liquidity. Hasn't been very great from a listing point of view, but there are numerous instances of IPOs listing at a discount, which is Page Industries or Infosys of the world, and going tend to. I don't think so. 1 day, 2 day should matter. Also, retail investors and policyholders did get a discount, so it's not that you are deep in the red on this. I think at one embedded value, and I want to just specify. See, you have to first understand how insurance business is. Insurance is you pay premiums now. The insurance company makes value over the lifetime of the policy, right? So embedded value is nothing but future profit. It's your net asset value and future profits of existing policies, right? And now what you don't know 20 years down the line how the interest rates will behave, how the markets will behave, how much will be the the claim ratio and all. So it's a difficult business, shooting into the future, and that's what makes the valuing insurance companies a little tricky subject. I think where LIC, you need to, if you are, so I think LIC is very reasonably valued at current prices. At one embedded value, I think there is some margin of safety with the kind of brand LIC has. Now, LIC has one major problem. So two problems actually. One problem is the product mix. So it has a large share of participative policies, which we call as PAR policies. PAR policies basically क्या होता है? You pay policy holders on the profit also. So there is a return policy makes, and then periodically there are bonuses or bonuses paid to policyholders participating in the profit of the fund. That unfortunately is almost 70-80% for LIC. So the focus of LIC was always distributing surpluses to policyholders versus shareholders, and LIC also used to intervene in the market on the insistence of government, right? So whether it was buying the IDBI bank, whether it is stabilizing market, right? And now once you get listed, the game changes. Now you have to be more focused on the shareholders, which means I need to increase the proportion of non-par policies. Non-par policies are where you only make money from the policy, which are like, in a simple language, are like your guaranteed plans, right? So that's one problem. So you need to change the mix of the product. The second problem is the dependency on the agency channel. 93% premiums come from LIC agents and their sales force, and that is why if you see renewals, only 30% happens online. It's somebody like an HDFC Life, ICICI, 80% renewals will happen online. So they need to up the digital game very, very clearly. Whether they can do that, I think we have seen SBI doing that. And if you have the management focus in place, that can happen. But all of this will happen over a period of time, right? It will not happen in 1 quarter, 2 quarter. It's a transition which happens because of the change of culture also. It's not just you can put in, technology and everything can change. The third important thing in my view is, which you be mindful of, is LIC is the largest money manager. It is 40 lakh crores. So amongst in world, it is the 10th largest. So currently, those are crore profit. Now this can change very quickly. So there is a risk to it if there is the market can be adverse, but there is a huge opportunity to scale up profits if they get their act right. Obviously transparency will come, their credit underwriting, the actuarial science, all of that will get exposed. So if your view is that you want to have a long term view, my personal view is insurance sector will do very well, and since that it holds 2/3 of the market, the next player is at 7%. तो बहुत बड़ा gap है to bridge. It's not like private. It's where banks were 10 years back. PSUs were 70%, private banks were 30%. It's something like that. This is like one PSU being 65-70%, the second largest being 7-8%. So I think the sector will grow. LIC may grow 12-13%, let's say 15% for the sector, and private insurers may grow at about 18-20%. So my preference would be private insurer, maybe one or two. So in our portfolio, we have HDFC Life, and I can only talk about my portfolio stocks. And maybe if you want to have more exposure to insurance, you can take it. It's like, having HDFC and ICICI in the portfolio and adding SBI, something like that. So take a basket approach. In general, I think the protection gap, the overall growth of the industry in terms of GWP looks very promising.
Gurmeet, what do you make of the timing of the IPO list, of the LIC listing?
I don't think so. I think that I think obviously, but मेरे हिसाब से ना अच्छा है retail investors के लिए. See, I don't know why we get so carried away. अगर retail investors को share सस्ता मिलता है, अगर ये 3 महीने पहले आता तो 2 embedded value पे आता. अभी 3 महीने बाद आया तो वन एम्बेडेड वैल्यू पे आया. तो फॉर एन इन्वेस्टर इट्स अ गुड थिंग इफ द IPO is coming in a market where sentiment is low. In fact, it's a risky thing if when everything is good. We've seen what has happened, right? Which IPOs which came at 18,500, all the new age tech companies, people have lost 50, 60, 70%. So I think it's a good thing.
Right.
I think we should view IPO basis the valuation and not basis the timing, in my view.
Just a thought out here. Is there a general fatigue that you think there's in the market with new listings?
Yeah, some of it is there, so especially if your experience last 6 months has not been that great, right? Always happens. So in October, any IPO you touched was making money without any sense. Now even good IPOs are struggling, right? So I think that was the one extreme. This is the other extreme, right? So obviously it makes a difference there. But I'm saying as an investor, you should be happy if you're getting good IPOs when sentiment is bad. That's when you get better valuation. That's when you get better margin of safety.
Got it. Okay.
Awesome. Gurmeet, so let's stick with the insurance sector itself then. We know the huge growth potential because of how underpenetrated insurance is in India, but somehow we haven't seen that pass through in terms of price action. What is the reason for this? Because like you mentioned that, these private players will continue to grow faster than the industry and will continue to gain market share from LIC. Somehow, investors haven't quite seen that kind of gains translate in for their portfolios. What's gone wrong there? Or what is the reason for this underperformance?
So I think they've been in a perfect storm in terms of bad news and events. So the COVID claims went up, the reinsurance rates have gone up, the renewals got impacted because of COVID. So people didn't. The persistency ratio fell. Persistency ratio is number of policies crossing a certain period. Like they measure it in 13 months, 61 months, etc. Because insurance is a back-ended and long gestation business. So if policies don't continue, profitability does get impacted. And as I said, that it's a difficult business to project profits because you're accounting for what you will make in future. So give you a simple example. Let's say we hear this term called VNB margin, right? Value to new business premium. Now VNB is basically nothing but, so let's say if HDFC Life, the VNB for last year was 27%, which means that on a 100 rupee policy I write today, of premium I receive, I will make 27 bucks over the policy lifetime. Now that's a measure of your future profitability. So higher the VNB, the better. So I think what impacted insurance was high claims, more provisioning, high reinsurance rates. All of that will now get a higher base, and I think incrementally you will see better profitability. And you should buy businesses when they go through, good businesses when they go through rough periods. I think insurance has gone one, and it's not just India centric. This has happened globally, and the valuations got the same. HDFC Life was, people were gungo giving it 5-6 times embedded value. Today you think 3.5 4 times embedded value is expensive, right? So it's happened because of, I think, the entire sector going through some stress. I think a lot of it will ease. The provisioning is coming off as the world, obviously the entire world has got vaccinated. Hopefully the new variants are not, and I'm using the word hopefully, are not as lethal. And I think the if you see the recent trend, so I saw the life insurance and general insurance April trend. There was a 20% growth in premium at the industry level, right? So this is a high growth sector where you will see the industry growing at 15-20%, and better ones probably doing better. And if once the cost normalizes, the provisioning reduces at 20% kind of growth, I think you will then probably see better price action, in my view, over the long run.
Thanks for that, Gurmeet. We have a question coming in from one of our listeners who's just messaged us and essentially asking you to take a view on Ruchi Foods, which has rebranded itself to Patanjali. What's your POV on that one?
Yeah, honestly, I don't have a view on that. As I said, I keep saying that don't buy basis, recent events or on news releases, and I think let the transition happen. Ruchi Soya has its own strength, and I think let the synergy happen, let the transition happen. I think they are very good players in if I were to call it as a consumer food business, there are a lot of opportunities there, and I think commodity consumers I think one has to be a little careful of what valuations you pay, because I don't see uh, margins really improving immediately unless there is a huge commodity deflation which plays out. We have seen multiple price hikes. Not every company will be able to get volume growth along with price hikes. If you see, don't get fooled by the revenue growth. If you separate volume growth and price hike to get a better difference, I think a lot of these companies are either being flat or reporting a degrowth in volumes. And if you pay higher multiples, you are inviting a bit of trouble in my view. So be careful. As I said, I started in the beginning that this is a year when 90% of the job is what not to do, and if you get that right, we've had 2 good years, and and that is what investing is. In tough years, you have to be careful of where you allocate capital, and you should not allocate where the headwinds don't seem to be receding very quickly anytime soon.
Got it. Thanks for that.
Gurmeet, sticking with the FMCG theme, and one of this recently listed company, Adani Wilmar, it's been a great wealth creator, but then it has also been extremely volatile. It went up to almost levels of 900 rupees and then back to 550. And in this recent pullback has also seen a decent up move. Any any idea what's going on with the stock? Do you track it by any chance? And uh, any take on that, basically? Gurmeet, can you hear me?
Yeah, is it better now?
Yes,
Yeah.
we can hear you.
So I'm saying during the IPO stage, it used to be was far more reasonably valued versus what it is now. And at that point of time, you got great valuations, reasonable. I won't say great valuations. So it's basically a JV between Adani and the Wilmar Group, and this, obviously they are growing the distribution reach. They are basically so their Fortune brand basically figures in one of the, is a top selling brand as far as the goods goes. Even on edible oil, they are clear market leaders. So if I remember correctly, basis, I have not tracked it for a while in terms of, as on March, I think they had like a 22% market share, and this was across the various categories of edible oil, which includes the rice bran, the soya, and the other varieties. I think right now, if you ask me, the valuations look pretty stretched in my view. It was what, I think 200, 250 when the IPO came. And I
Yeah.
think apart from the oil segment, which it is clear leader, they are now getting into wheat flour. They're getting into pulses. They're getting into sugar. They are actually trying to capture a lot of your food items on the kitchen shelf, which I call. They're getting into packaged food as well, and then there are obviously into the some of the industry essentials, right? So they have this couple of strong brands, including Fortune. But at this price, in my view, I mean, I must admit that most of us have missed Adani rally in most of the spaces, because, as I said, I'm still old textbook. I need to see cash flows and better valuations.
Gurmeet, I just want to zoom out and just look at a trend of a lot of people talking about investing in stocks that are international through a lot of these new cool fintech products that are out in the market. What is your take on this?
So, which ones you're saying? Are you talking
The
about?
general trend of people wanting to buy stocks of the US bourses, sitting in India and investing
Yeah,
abroad.
yeah.
What do you make of this? And do you have any guidelines for people to keep in mind before they say, "Hey, I want to buy an Amazon or an Apple stock," and dump a big dollar on it?
Yeah, so my personal take is that I think ETF route for offshore investing is a better route in my view. And so if you look at, for example, Nasdaq, right, and Nasdaq has corrected almost 30%. I think it started the year at almost 16,000, and you're probably at about 12,200 or something, right? So clearly, it's seen a, and some of the stocks have corrected more than 50%. Some of the stocks actually went down 50%, in a couple of days, right? I'm saying despite all of this, if you see the 10-year returns, right, of Nasdaq, it is still 20%, 21% annualized, right? To me, that's a great return, right? Adjusted for currency and everything. And I find this entire discussion ना अल्फा जनरेट करना है, मैं स्टॉक पिक करूंगा, मैं इंडेक्स को बीट, मुझे थोड़ा ओवररेटेड लगता है. Anything you have little access to in terms of information, in terms of your tracking, you should become a little more passive. Go into a managed portfolio, and it's okay if if you're bullish on, and Nasdaq is 45-50% technology, and amongst the most disruptors of the world, it's okay. Go for the index. Today a Tesla is doing well, tomorrow an Amazon could do well. Amazon at a 52-week low. My personal favorite in as one of the stock has been Apple. I personally think it's a consumer tech stock with the kind of ecosystem it has, right? With the kind of anything it comes up with, is despite all the memes on social media is a hot seller. So they are selling 10-12 billion dollars of AirPods. I've never been able to make much sense of that, right? But I'm saying that that's one stock I like because I think there is a consumer ecosystem and an affinity attached to it. Other than that, Berkshire is another proxy to investing in US businesses because Berkshire holds a lot of businesses. But my personal preference would be that stick to a couple of ETFs and don't go beyond 10% of the portfolio. There was this fashion in India of some funds doing 30-40% US stocks. There were innovation funds being launched, and this was all launched at a peak. And this is the classic rear view mirror approach, which we get it wrong.
Got it. Thanks for that, Gurmeet. Yash?
So, Gurmeet, moving from the consumer tech companies to our very own IT services stocks, they have been one of the biggest laggards so far this year. What has changed so dramatically, and are these levels a good entry point to nibble into some of these names, maybe the large cap ones or the mid cap one? Which is your preference over here?
I think you should play a basket approach, in my view. So obviously, if you pay a 40-50 multiple to an IT service company, I remember some people comparing IT services with FMCG, right? He said Infosys is like Asian Paints, and I think that's a typical sign that we are now looking for new narratives. In a bull market, when you start saying this is the next, I remember the next HDFC Bank theories in 2018. We've seen all that what has happened to all of them, right? So I think what I track is the demand momentum. I think the demand momentum looks very solid. If you see Infosys, for example, and this is again not a recommendation, their commentary is still about 14-15% growth with 22-23% margin. Last year, deal TCV was almost $10 billion. So I think that there are new spend areas emerging in digital. It is not just restricted to cloud. Also, a lot of companies are getting differentiated now. They are coming as a co-innovation partners, and a lot of the deals they are getting are growth and transformative in nature. You call them a GNT, right? And that's also if any company which is getting those kind of deals which are outcome driven, pricing pressure would be less. There could be a near term, tailwind because of currency, because every 50 bips on the rupee adds about 5-10 bips in the short run to the EBITDA. The other one which has corrected a lot, I think is Tech Mahindra. I think is corrected a lot. It had a bit of a rough quarter last one, but I think 40-50% revenue comes from communication, and this is the year where you will see next 12 months, a lot of spending happening on 5G, on equipment modernization, and etc. Uh, uh, Also, they are pruning on less economical geographies. Some of the mid cap names have taken a quite a beating. So I think make a basket approach. I think the valuations are reasonable. I will still not call it fair, considering the sell-off in US tech. But I'm saying the demand environment is solid. So I mean, if you have a slightly longish view, I think the trend looks good.
So moving forward, Gurmeet, let's look at some of these chemical companies. They have come out with extremely good numbers. SRF, Vinity, NoSil, even Galaxy Surfactants for that matter was up almost 5% today. What is your take on the chemical companies? Do you think that the worst in terms of the margin pressure is behind us and we can start seeing these chemical names again starting to move higher?
So Yash, I don't want to generalize it. In terms of that, all specialty chemical companies are looking good. It happened last year. क्या होता है हमारे साथ problem क्या है? Every time we start looking for a buzzword. So you remember in 2018 it was HEG and all carbon electrode makers. अभी लास्ट ईयर स्पेशलिटी केमिकल हो गया था 2020 में फार्मा सीडीएमओ लोगों को फुल फॉर्म नहीं पता कॉन्ट्रैक्ट लोगों को फुल फॉर्म नहीं पता कॉन्ट्रैक्ट रिसर्चिंग मैन्युफैक्चरिंग सो आई थिंक दिस इज अ टेक्निकल सेक्टर there are different companies which operate in different chemistries. I think one has to be very careful on that. So I'll give you an example. Now,
Hmm.
since you talk about few results, so what has happened in now chemicals is that a lot of these contracts have annual repricing. So some companies are able to pass on the high input cost and are able to reprice the contracts. And in some chemicals, the demand is still buoyant and supply is still very, very tight. So let's, for example, look at soda ash and let's say Tata Chemical. And again, this is not a recommendation. I'm just talking. I can't make recommendations due to compliance reasons. So I'm saying let's talk of soda ash, for example. Very favorable demand supply scenario. All plants across country, not just Tata Chemicals, they are almost running at 97, 98% utilization. And there is strong demand, also accruing from, lithium carbonate batteries and solar panels, right? And the spot market is very, very tight. So I suggest people that once you start tracking specialty chemicals, track the spot prices of different chemicals. Also go a level 2, right? If you're not able to do that, don't get into this. This is something you need to get very close to the pulse. And then Tata Chemical got into making battery materials and specialty chemicals, and we saw good numbers coming in. You pointed out few other names. In some places there is still, in my view, the margins will come under pressure. So another company which I think has done a lot of capex in this year, probably. So look at Deepak Nitrite, for example. They have a 1,200 crore capex, right? 800 in the base chemical and phenolics, and 400 crores towards new chemical or green chemical or whatever is the new buzzword these days, right? So track which companies are doing forward and backward integration. Track companies which are getting more operational efficiencies. Track companies which are doing this innovation led capex, and not just because the industry is going through my capex kar leta hu, right? And be a little careful. I personally think benzene based phenol soda ash, I think, are better plays rather than just picking up anything and everything without understanding what really is it's into.
Point taken. That's a great piece of advice, because generally people try to paint the sector with the same brush that every other chemical company, and you will start seeing some really shady small cap companies or micro cap companies with very low volume also surge just because it is labeled as a chemical and specialty chemical company.
Absolutely. Absolutely.
Awesome. Um, Sahil Kapoor has also requested to join us as a speaker, so I'll just quickly give
Please.
him access.
Yeah, please have him in. I can see Avinash also and Nitin
Yeah.
also. I think it's good to take more views. And Prableen has also joined. Yeah. Thank you guys for tuning in.
Hey guys. Avinash, I've sent you the request as well. Sahil, I'm unable to see if you have managed to accept it. Okay. We'll try and reconnect with them, but
Sure.
Gurmeet, let's move forward. So another event that happened last week, probably not the best, was the Axis Mutual Fund issue that we saw, and it has brought to light some of the issues with the mutual fund industry and the way it works. What do you think needs to be done in order to fix this and avoid it from happening in the future?
So I think I think while the inquiry is still pending, I can't comment in terms of the nature of the violation. But it definitely dents the confidence of the market, especially in times like this, right? But whatever. So what I did was I think Axis has taken a proactive inquiry, and there are for few rotten tomatoes we should not paint the entire industry. I think mutual fund industry has done a great job in getting retail investors, and I still think, and I have no bias against any platform, whether it is small case or anything. I think for a retail investor, mutual fund to me is still the best option. I think a lot of us get carried away, and so unless you have the knowledge and time, I would still prefer. In fact, I personally still do SIPs of almost 30-40% of my portfolio, and I have no comment, in admitting that. Sometimes people call me a retail investor, so be it. I started off as a retail, And I think a lot of the portfolio managers I look up to, and they've done a great job. I think if there is anything wrong, I think an example should be made, in my view, to restore the confidence. I've been checking some of the funds where the without taking names, there were names which have been coming on light. I didn't see any adverse movement as far as the NAVs go. I did not find too many things in the portfolio also in terms of tracking the portfolio changes also between March and April, and even in from February. So far I don't think so. There seems to be any scheme or a fund specific risk as of now. And some of the names, some of the schemes where the concerned people were, there were more ETFs and arbitrage, which anyways can't do much in that. So I personally think that the industry, I think, will move forward, and I still think it's a great vehicle. But in case there is anything which is found and which is not as per the right compliance and ethical benchmarks, I think the regulator will step in. So I don't think so. Retail investors need to too much worry about it as far as the access schemes are concerned.
All right. Avinash sir, just to bounce you off the same question, we were discussing about this Axis Mutual Fund issue. You have been around in this industry and you know how it works. What is your take on this thing, and what should investors of these schemes do?
Yeah, I think yes, this Axis Mutual Fund is definitely something which has created a little problematic situation for some of the retail investors. But let me tell you one thing, that in this industry, this kind of front running is not completely unknown. It has been happening for a long time, and I think as far as mutual funds are concerned, I think of course corporate governance standards are very high. So typically, I think what happens first is that retail investors get panicky. They try to dispose of their holdings. But let me assure you that all the schemes where basically Axis Mutual Fund has put money in all quality stocks, I don't think it's going to be like a panic sell-off. So I think guys who can hang on for a longer period, the water will settle down. But yes, in the near term, there could be a lot of guys who could obviously exit their SIPs and move into some other mutual fund. But my only suggestion is that if the scheme is consisting of good quality companies, good quality businesses, then I think definitely one should hang on. In fact, people who are not investing in SIPs and probably want to buy even these stocks, if they even correct, because of some panic, I think that would be an excellent way to accumulate these good companies. Because finally, there's nothing wrong with the mutual fund scheme. It's the corporate governance aspect which has got impacted, and I think over a period of time this will get corrected. So I think these are things which are part and parcel of the game. Yes, I don't think one should be so negative. As Gurmeet also said, that you can't consider everybody a chore. So there are some good fund managers. There are some obviously some not good fund managers, some dealers. So obviously these things are not good, but we have to live with it. And I think we need to look at the big objective and the bigger game plan. These things obviously are a impediment in the short term, but in the longer term, I think all this gets neutralized. Ultimately it's the wealth creation journey, and I think in that mutual funds definitely play an important role. And Axis is definitely not some mutual fund where they have invested in some kachra companies or they have invested in some bad businesses. So to retail investor is pretty safe here. So I think life will continue to go on. But yes, in the short term, you'll probably hear a lot of retail guys, a lot of Twitter kind of comments have come across that mutual funds are not good to invest. These are things which I think investors should avoid, because finally the longer term aspect of this mutual fund industry is very bright. And I think for retail investors who don't understand companies, don't have access to information with managements, I think the best platform for them is mutual fund, because that is something which is going to be taking care of the inflationary kind of aspect. And equities definitely should either be invested directly or through the mutual fund route. So my suggestion is don't worry. I think the water will settle down and things will get back to normal soon.
Okay. And Gurmeet, do we still have you on? Okay, I think
Gurmeet's fallen off.
yeah. Okay. So Avinash, let me ask you this. So far we haven't seen, crazy 40-year high kind of inflation levels in India. Although on ground reality might feel different, equities as an asset class is also feeling the pinch. What would be your advice to young investors who are witnessing these tough times for the first time? And what is the ideal asset allocation they should have, and what are the kind of mistakes that they should avoid?
Yeah, I think Yash, for youngsters, who are in their mid 20s, typically the Robinhood investors, which all of us have seen in the last couple of years. My suggestion is that please look at equity as an asset class for the longer term. The momentum market would not continue because obviously COVID market was different, and thereafter 2021 was excellent in terms of in terms of stock return. 22 is going to be different. It's going to be very painful. It's going to frustrate a lot of these young guys because they haven't seen a bear market in their entire career. So unless you see some pain, longer term, upside cannot come. So my suggestion is, when you look at equity, take a 3 to 4 year kind of time frame and have the patience and the maturity to actually ride the entire, value creation journey rather than just looking at 5, 10% or 20% upside. And that is exactly what these youngsters should be doing. I mean, somebody who's below 30 should have an asset allocation of at least 65 to 70% in equity and the rest possibly in some debt funds or maybe in some other asset classes. But definitely, I think, below 30 years, if the, participant is there, then I think he should have the capacity to take a larger part of equity in his portfolio because, in the early part of his journey in his productive years, he can definitely invest in equity, which can later on give him significant returns, when he matures and obviously he has got bigger responsibilities going forward. So I think the point which I would like to drive is that equity is not a quick money kind of solution. It's going to see ups and downs, and inflation, as you rightly said, is just starting to move up. So please don't be surprised. We could see another 50 basis hike here, and that could possibly, obviously disappoint a lot of people in the market. But at the end of the day, it's going to be earnings and earnings which are going to matter. And I think there are many companies who still see decent kind of earnings growth. So, you got to dig more and, just observe more. And, the journey will become interesting only when you know how to, face these kind of challenges. So, my sense is, I mean, just think long term. Unless you think long term, equity will not make money for you.
On that note, you should just tell us what do you consider as long term for the young people. It's very different what long term is for older people.
I think my guess is, see, I think today long term is 3 months for youngsters, 1 month is short term. This is what the reality is, and I think one can't help it. We have got TV channels. I mean, without taking names, I would say that people expect returns in just a few hours or few minutes, and for them, 2, 3 months is a very long wait. So I think this is the kind of culture which unfortunately we are breeding, and we are educating our youngsters. So I think you need to have a lot of maturity. You need to have a lot of patience, and time is the solution for everything. I mean, my investment strategy is very simple. I try to double my capital in every 3 years, and I just sit on a stock. I don't bother to look at it every day. So people may call me a little stupid guy, but I believe in the value creation journey. So once I take a commitment and I have the conviction, I don't change my decisions every hour or every minute. So equity must be done only by those guys who have a stable and a mature kind of focused approach to their financial planning approach. Somebody who's a trader can never be an investor. So somebody who wants quick money will obviously have to go through the painful process of market correction. So that is where possibly the youngsters have to be a little mature. And I think money making is not that easy. People think stock market में पैसा बनाना बहुत आसान है. Anybody can do it. I think it's not like that. You have to go through a lot of pain, agony. And most importantly, you're going to see at least 1 or 2 bear markets to actually experience, equity.
Thank you for that.
Interesting.
Yeah.
Gurmeet, I want your thoughts as well on this. What I essentially asked Avinash is that, these are such trying times. We've not seen such high inflation in 5, 6, 7, 8 years, and a lot of the young investors, they too are going through these times for are experiencing this for the very
Yash,
first
did we
time.
just lose you
What
for a
would be
moment?
your advice to them, and what is the most ideal asset allocation they should have? Should they move out, or take out some of the cash, move into debt, and what are the kind of mistakes
Yash, I
that they
think
should
we
avoid?
lost you for a moment. Gurmeet, if you could just come in on that, please.
I can hear you, Yash. I heard the question. I think, see, I can talk from my experience, in last, few years in
Am
the
I audible?
market. Yeah. Am I audible,
Oh,
guys?
yeah, yeah.
Yes, sir. Loud and
Yeah.
clear.
Loud. Okay. So I was saying that, one mistake which I did, and I can tell you of 2008, was I stopped my SIPs. I panicked, and I think that was probably one of the worst decisions I took. Because the market still I've seen a 70% correction almost. So I remember 27th October, I think it was the date when Sensex came down to 8,000. In January was 21,000, right? So the and one SIP I forgot to stop. I think that time there were no digital.
Gurmeet, your audio is suddenly a little faint. There is something that you did, I think perhaps with your headset or something. You're suddenly a little faint, a little far off, to be honest.
Is it better now? Yeah.
Yes.
Yeah, so I'm saying
Perfect.
one of the SIP I forgot to stop. In fact, and that actually continued for. So whatever investment happened in that period in that SIP, actually, when I saw that in 2011, I realized that probably that was the best thing to do in terms of stepping it up, and I should have continued. So my advice is that if you're a retail investor, first thing you should be very clear that this is not the first correction. This won't be the last. You will keep getting these in the next foreseeable future. So you have to be ready that over a, let's say, if I have a 10-year to 15-year equity journey, I will get probably plenty of those. I will get probably two or three large ones, and by large ones I mean 30, 40, 50%, and I will get every year or every alternate year 10, 20% correction. I think, and this nobody can get away with. Number two, as Avinash said, that see, I am somebody who slightly I have a different approach in terms of having quantity goals. I've been talking about this for some time across various platforms. I have a very clear goal that by the time I hit 50, I need to have an X quantity of shares in my demat, and basis that I calculate my passive income. Right. So I have a different way. So I have a view that I should have 5,000 Infosys, I should have 3,000 TCS, I should have, let's say, 5,000 Tata Consumer, and so on and so forth. I have a list of some 20 good businesses which I want to own. And basis that, I have my view is that my passive income should take care of my 9 to 5 job. And I think I have been doing it for last 12, 13 years, and I am very near to that goal now, because of the reason that I continued this in 2020, I continued this in 2018, I continued this in 2013, and I learned from 2008. Right. So my advice to all young people is, right, if anybody is giving you information on WhatsApp, on tips, if you think by following somebody on social media or listening to somebody on Spaces you can become an overnight fortune, I think you are in for a rude shock. So everything in life, it's like मैं last दिन पढ़ के थोड़ी 90% ला सकता हूँ. Right, somebody who's studying every year, I can't beat him, not just because I will study 18 hours in last 2, 3 days in the before the exam. Or if I am a sportsman, I certainly can't run 4 days and then clock a marathon. No? I need to keep practicing. So the discipline will score over intelligence, and I think this is one thing. If you can inculcate in your brain, I think you will achieve some great results. And trust me, guys, the results. The first 4, 5 years ऐसे लगता है कि कुछ हो नहीं रहा है portfolio में. Right? But once you start crossing it, no, once you start, getting into that 9, 10 year, 11 year, you start realizing that, what have you accumulated over a period of time.
Quick question. How old are you, Gurmeet?
I'm 41.
Thank you. That puts a lot of things in perspective. Thanks. Yash?
Gurmeet, you said that when COVID happened and you stopped all of your SIPs except for one. So I'm very curious to know how many mutual funds do you have your SIP in, and what would be your advice? Like how many funds are enough, or how many is too much, and how much is too much, and then what sort of allocation should they have in like which schemes,
Sure.
debt or balanced advantage fund, which categories?
Sure.
I
So I didn't stop yes my SIPs in COVID. I stopped in 2008.
Sorry, 2008. Yeah,
Yeah,
I
yeah.
stand corrected.
So I see. I made a mistake of having some thematic funds also that point of time. उस time पे infrastructure funds used to do very well. There was this fund of Reliance Power. उसने एक साल में 110% return दिया था. I started an SIP in that. That's what we do. We look at various portals. We figure out funds. Oh, this is a small cap fund. It's given 100% return. Let me start a SIP. We don't really plan things. I think one formula which has worked well for me. It's not a standard formula. Is something like 30 40 30, and
Okay.
so this is like 30% in an index or a large cap,
Okay.
45% in a multi cap focus funds, and the balance in small mid cap and offshore, right? So that is how I have constructed the portfolio over a period of time, and I think 4 or 5 funds are enough, because a typical fund owns about at least 40-50 stocks. तो आप 10 फंड ले लोगे तो मेरे हिसाब से फिर आप BSE 500 का ETF ही खरीद लो. There's no point having 10 funds, in the portfolio, and this is irrespective of size. I think people confuse that I have a larger size. I should buy more, uh, you know, uh, uh, on this. So basically, I think 4 or 5 funds are enough, and that maybe you can have 1 or 2 passive and 3 or 4 active. This is not active versus passive. I find this debate, and I also do a stock quantity SIP. So I have selected some businesses over a period of time because I get a lot of time to research. I'm into this profession, and this you should only do when you can give that kind of due diligence to any business you own. You should not do it basis what I am saying or anybody else is saying in media. On the asset allocation bit, I am being a little more aggressive on equity. I just have two debt investment. That is my PPF and my is 8%. But if you have a near term goal of 3-4 years, 5 years, that pocket could be a house, could be whatever. That pocket should. So it has to be goal driven. There's no standard formula कि 60 होना चाहिए, 40 होना चाहिए. एक formula है जो थोड़ा सा relevant है, which is 100 minus age. So the younger you are, the higher should be on the equity side.
Gotcha. Gurmeet, Avinash, gentlemen, we are nearing the end of the time that we have for this discussion. Just want you to quickly get in your thoughts as to what do you make of crypto. I mean, crypto is getting beaten black and blue, but your general, overall, high-level thoughts on what you make of this space, given the excessive interest that is there around this domain.
Yeah, I think as far as crypto is concerned, I think these are guys who are basically very high risk takers, and I think one reason is basically this market is still a very immature and an imperfect market. So my guess is in this kind of price corrections and well destruction kind of cycles will happen. So whoever is entering this crypto kind of asset class should realize that it's going to be very very volatile. It's not going to be easy to make money. And finally, at the end of the day, unless you understand the risk and unless you are willing to sacrifice a decent part of your capital into potential losses, only then enter the crypto market. There's a lot of money to be made here, but unfortunately, no one has the skill set. Nobody knows what are the kind of variables which actually work here, unlike other asset classes like equities or commodities. So I would be a little careful about this asset class, Ashwin. I think it's better to focus your energies on something you know better and where your skills are, properly, fit to take care of those asset classes. Something which is new, which is a new animal. I think it takes time for you to understand it. So, I would prefer to keep away. So I think a youngster should remember that if you do enter this segment, I think you need to be careful as to what are the risks which are attached to it, because risk management is going to be very crucial in cryptos.
True, and the amount of variables is incredibly, incredibly high. We discover new variables every second day that are changing this space. So thanks for that, Avinash. Gurmeet, your closing thoughts on what do you make of the crypto space?
Yeah, I've been staying away because my simple rule is anything I don't understand, I don't invest. So there are a couple of spaces I don't understand. I'm not a techie. See, I'm a great believer in blockchain technology. I'm a believer that you should adopt technology. But I'm not a great believer in few computer algorithms, becoming currencies, and just because it's difficult to mine and all those theories. Maybe one or two may survive, because of the widespread usage and maybe too big to fail syndrome. So I haven't invested, and I sometimes differ with my partner Kshitij on this because he thinks a small portion should go there. So it's like casino, if you are, we saw what happened to Luna. It became zero in one day. So
Yeah.
part of money you are okay losing in a day, and it doesn't affect you mentally. I think you can. It's like going to a casino. Have fun, but have a stop loss in place.
Yeah, I mean that's what we tell everybody is put the money that you can write off and not completely derail your life as such. Great, thank you for that, Gurmeet. Thank you, Avinash. Really appreciate your time on behalf of StockTwits and BI India. It's been a delight to have you gentlemen pop in and have a chat with us this Wednesday evening. And for all of you listening in, we are usually here every Wednesday evening, and on Thursdays we talk about what's happening in the world of Web3 technologies. That includes what's happening in the crypto and the NFT worlds. And we also talk about the newer technologies that are coming out there. So it's not entirely a discussion on just the coins and how they're moving up or down mostly at this point of time. So, yeah, thank you.
Thank you so much, guys. And in case you've joined us late and you want to go back and hear the entire conversation, you can check out the StockTwits handle. It will be the first pinned post at the top, and we highly recommend you go and hear it from the start. And that's all that we have for today. Thank you so much, Gurmeet and Avinash, Ashwin as well.
Thanks, Yash.
We look forward to having both you gentlemen back in the near future. It's usually a fun chat, low stress. So thank you so much again.
Thank you.
Thank you.
Cheers.
Thank you, guys.